In 1869, two of America's most powerful speculators believed they had found a way to control the price of gold. Their names were Gould and James Fisk, and their plan was simple: buy as much gold as possible, restrict its supply, and force prices higher. At the time, gold was essential to the American economy. Farmers sold crops overseas, international trade depended on gold, and even a small change in its price could affect businesses across the country. Gould and Fisk quietly began purchasing enormous amounts of gold, but controlling the market required more than money. They needed the United States government to stay out. If the government released its own gold reserves, prices could collapse. Using political connections, the traders attempted to influence officials while continuing to buy. As rumors spread, investors rushed into the market. Gold prices climbed rapidly. Traders borrowed money, placed enormous bets, and believed prices would continue rising. Then on September 24, 1869, a day that became known as Black Friday, the government intervened. Millions of dollars worth of government gold entered the market. Within minutes, prices collapsed, fortunes disappeared, investors were ruined, businesses failed, and financial panic spread across the country. Gould escaped much of the damage by secretly selling before the collapse, while many ordinary traders were left holding enormous losses. There were no computers, no trading apps, no electronic charts, but the forces behind the market were remarkably familiar: influence, speculation, leverage, greed, fear, and the belief that prices could rise forever. More than 150 years later, the technology has changed, but the psychology behind a market bubble remains almost exactly the same.